I'm joined today by Andrew Miller, the Managing Director of Residential Credit at Pretium. Andrew is among the incredible investors sharing insights at the Family Office Investment Forum today. Welcome, Andrew. It's great to have you with us.
It's very nice to be here.
Let's dive straight in. What makes US residential credit an interesting asset class for investors to consider including in their portfolios?
Well, the first thing is it's very large size at over $14 trillion. I think many investors are not aware at how large U.S. residential credit is. And given its size, it has many varied and interesting subsectors, which allows investors to express different views. And then lastly, it's non-correlated with a lot of other asset classes.
How's the current economic environment impacting US residential credit?
Well, it's interesting that you bring that up. The U.S. economy, as many are well aware, is sort of on the edge of a recession. And so if the U.S. does happen to go into a recession, we expect to see a significant increase in distressed asset supply, both in non-performing loans and also in mortgage servicing rights. For example, a 1% increase in delinquencies in the U.S. residential market would generate an additional $150 billion of non-performing loans. And there aren't very many natural buyers of that additional supply, so we think that will generate very compelling investment opportunities. And if the U.S. doesn't go into a recession, then we would expect interest rates and mortgage rates to stay higher. And that will create opportunities in other asset classes, for example, second liens, as homeowners look to tap the $31 trillion of equity that's accumulated in their homes.
And what are some of the key trends in US residential credit that are driving investment opportunities?
So one key trend has been the transition away from banks to non-banks. For example, non-banks now originate 2/3 of all residential mortgages, and banks have also pulled back a lot in their lending activities. And so this creates an opportunity to partner with these non-banks as they're looking for someone with capital to be the buyer of their loan originations. We see this opportunity presenting itself in two particular areas: non-qualified mortgages or non-QM, and also home builder loans. A second trend that we've been noticing is the aging of the housing stock in the United States. The average age is up to 41 years, and in certain states it's as high as 62 years. This has created a significant supply of residential transition loans, which are used to renovate those old homes. And so that's a very attractive investment opportunity as well.
And what are the key capabilities an investment manager needs to have to achieve success in residential credit?
I would say the most important thing is for the investment manager really to view it as a long-term strategy and not just a trade. So beyond having an experienced and knowledgeable investment team, around that investment team, you really need to spend the time and the money to build out the associated infrastructure. So it's critical to have dedicated sourcing engines so that you're not competing for all of your new acquisitions. It's also critical to have your own asset management team to maximize the value of your assets, and also to have your own loan servicer who's spending the time and the energy on each individual loan, ensuring the best outcome there.
Thank you, Andrew. We'll have to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Family Office Investment Forum.
Thank you.